Hello and welcome to Accredited Real Estate Schools. This is Bryan Church and this is the California Real Estate Review. We're going to talk about exchanges today. Okay, let's give an example of how these exchanges work. So you have a income property. That's a property that's been deriving income usually from rents. And you bought it 10 years ago and you had a 10-year holding period and you're selling it today. And so what happened is that you are selling it for, let's say, $200,000, but you have $10,000 in commissions and other expenses that go with it. So your actually adjusted selling price is going to be $190,000, and that's what you'll be paying your capital gains taxes on, is that amount. And you paid for the property, you have an adjusted cost basis of $90,910. And how they came up with that is you take the amount that you paid for the property 10 years ago, then you add permanent improvements that were made to the property during that 10-year period. That actually helps you because it reduces the amount of your capital gains taxes. But you also have to subtract accrued depreciation. And during that 10-year period, each year the IRS allowed you to do a paperwork loss called depreciation. And that, of course, helped your taxes each year. But at the end, the IRS says, okay, we'll let you take that for 10 years. Now we want to recapture that. It's called recapture. So they're going to want some of that back. And so that adjusted cost basis is going to include, of course, an addition of the permanent improvements and also subtraction of all the accrued depreciation that you took during the 10-year period. This example comes out to $90,910 adjusted cost basis. So our capital gain on this is going to be $99,090. So this is how much you would end up having to pay capital gains taxes on to IRS, Internal Revenue Service. And that, of course, is a gain. Now, the capital gain, you would take that and multiply it by capital gain tax. And that tax varies. And for example, here is that $99,090. You would multiply that by 15% for the IRS. And that could be more than that. And matter of fact, there are some proposals that even want it to be as high as over 39%. So 15 is actually not that bad of a deal. Now, on top of that, you're also going to pay some state capital gains taxes. If you're in California, that could be around 13.3% or even higher or lower. But that's the state franchise tax board in California. So you'll pay both of those. In this example, we're just using the Internal Revenue Code, the federal taxes. So your tax will be $14,864 you'll pay to the Internal Revenue Service taxes that you had. Okay, and what you can do with that is you can either pay those taxes or you can exchange them. Now, you pay the taxes to the IRS or you can do an exchange. And there are a couple of types of exchanges that you can select. The first one, investor sells income property and receives a capital gain. The investor has two options: pay the tax or do an exchange for another higher priced property and follow very strict rules. Now, the two types of exchanges that you can select, the first one's called straight across exchange, where each investor exchanges properties directly to each other. Now, these are fairly rare because it's very hard to find one property owner who's willing to exchange directly to another property owner. The delayed exchange, though, and it's called the Internal Revenue Code 1031 Tax Deferred Exchanges, it's the name of it. And this is delaying the exchange. And what this one does is the investor sells the property and reinvests proceeds into another like-kind property. That's any real estate for any real estate within a prescribed time period. What happens is when you sell your relinquished property, you have 45 days to identify your acquired property you're going to be acquiring, and then you have 180 days to close that property. If your taxes become due during that period of time, it could blow your exchange. So that's why you always consult with tax and legal advice on every transaction. And any clients that you might have, make sure they do that as well, because you want to see a CPA or a tax attorney and find out, because there are a lot of strict rules here. And if you mess up on it and not follow those rules, you could blow the exchange. It can cost a lot of money to do that. So that's exchanges allow postponement of capital gains taxes. So what happens is that you're deferring it. It's not tax-free, you're tax deferred, and it's delayed, so you're going to push it out. So what happens is you'll be paying those capital gains taxes sometime in the future instead of right now. And so you get to run on that money, and then you pay the capital gains taxes, or your heirs do that in the future. So those are exchanges. And so we have the disposition, right? That's it. And we have the sale proceeds. And what they do is they go into a qualified intermediary. So when you sell that disposed property, you can't touch the money. It goes to a qualified intermediary like asset preservation, and many of the escrow and title companies have exchange divisions. And it goes to that qualified intermediary into their trust account, so you can't touch it. Then you find your acquired property. You have to identify it within 45 days of the sale of your disposed property. And then you have to do the acquisition, buy it within 180 days. And again, taxes become due, could end up messing up your exchange. So you want to definitely see a qualified tax help on that one. And so that's the 1031. It's called Internal Revenue Code 1031 Tax Deferred Exchange, one you'll see quite often out in the real world. And it's Accredited Real Estate Schools, Bryan Church. And thank you very much, and have a very good day.